Welcome to ETF Leaders, powered by the New York Stock Exchange. Joining me today is Matthew Bartolini. Matthew is the head of Spider Americas Research at State Street Global Advisors. Matthew, thanks for joining me. Great to have you here on the show.
Yeah, great to be here too.
Thank you. All right, so tell me, what are your expectations for 2022?
So, I think we've obviously witnessed a significant amount of volatility in the first quarter, and I think it gets a little bit better from here on out. I think one of the things that we've been interacting with within the marketplace has been this sort of fundamental vacuum. We haven't had a lot of fundamental news to drive the markets. It's been mainly macro, obviously with the Russia invasion of Ukraine, the Fed really changing their policy stance and becoming much more hawkish, inflation numbers coming up higher than expected. But I think going forward for the rest of the year, we're going to have some more fundamental news now in the April and May timeframes, and earnings continue to sort of be revised upwards for overall 2022 growth. And I do think in the first quarter, we're going to get a bit of a surprise upwards. Historically, 77% of companies beat their earnings. And if that happens, I still think we get double-digit earnings growth in Q1, which is something I'm keeping an eye on. And I think that can generally support the equity markets as we head deeper into 2022.
Okay, so tell me, how active management helped to navigate anticipated market volatility, Fed policies, inflation, Ukraine conflict this year?
Yeah, I think it's going to be most appropriate within active constructs, within active strategies. Bond portfolios right now are really challenged. You know, the ag is down roughly 8%, and if you take that figure, it's worse than the 3 worst years combined. So bond portfolios are severely challenged. The yield on passive index core ag structures is also well below expected inflation over the next 4 to 5 years. So for an active manager, you can start to really change your duration profile. You can go into different sectors. You can utilize different structures like senior loans that have a yield above 4.5%, but also have a duration of only 0.25 years because they're adjusting and they're floating. So I really think active management works well within fixed income, particularly in this given market environment. In 2021, we saw 86% of intermediate core plus managers beat their benchmark, and so far the results in 2022 have been pointing upwards as well.
Now, how do you think advisors should be preparing their portfolios?
Well, I think they should take a holistic view on both the equity and on the fixed income side naturally. I think also start to figure out how you can incorporate some alternatives, because we are witnessing a higher stock and bond correlation right now, and alternative assets can help mitigate some of that and actually improve the diversification profile. I think within equities, you should still have a bit of a defensive bias, but not go risk off. Just maybe trim beta exposure down a little bit, focus on quality, focus on value. We like those factors now. Within fixed income, again, you want to be mindful of your duration profile, and I think the one sector we have the most conviction on right now is senior loans, just given their floating rate profile, seniority in the capital structure if you do have credit stress, but also that yield component, 4.5% yield, that's above the expected inflation rate over the next 4 to 5 years. That's something you can't say within traditional core bonds.
Okay. All right, Matthew, thank you so much for joining me, and that's ETF Leaders, powered by the New York Stock Exchange.